A U.S. House Democrat, a member of the Financial Services Committee. Congressman joins me from Washington, D.C. Good evening, sir. I'm grateful for you. Thank you. I sort of have a certain weariness that we're talking about regulation to, if you like, disgorge or punish. I thought we did all this back 10 years ago after the great financial crisis. So why are we doing it again?
Well, Richard, you're right. Dodd-Frank, of course, gave the government the ability to claw back bonuses that were awarded to executives prior to banks having difficulty. Now, the problem is, as we're now learning, that authority may not be specific enough to allow for that in the case that we, of course, have been dealing with in these last couple of days. And you know that the underlying issue here, of course, is that it is not hard in the financial services industry, certainly in the banking industry, to make more money simply by taking on more risk. And so I do think we've got to look in to see whether we need more expansive authority to make sure that accountability is visited on those people who take unnecessary risk.
The problem here is they took more risk, but with not very risky assets. In the sense that we're not back at GFC with subprime and various tiers of mezzanine finance. Here we're talking about rising interest rates, which cause problems in balance sheets, basically. And I'm wondering why regulators in California, banking regulators, state banking regulators, weren't more on the job.
Well, Richard, I'm not sure I agree. I mean, yes, United States treasuries have no repayment risk at all. Of course, assuming that we get the debt ceiling done, they have no repayment risk, but it's banking 101 to know that any long-dated bond, anything that is not very, very short term in the fixed income in the bond world, as rates rise, the value of that bond will go down, right, even if it is a United States Treasury. And that's precisely what happened. And again, it's banking 101. It's the things that people first learn when they go to work at a place like Citibank or JP Morgan, or presumably Silicon Valley Bank. So they were absolutely not risk-free securities in the context of rising rates. And these bankers, back to your earlier question, they get paid an enormous amount of money to manage that risk. And they just blew it on one of the most sort of fundamental principles of banking this time.
So how do regulators stop? I mean, people, you'll tell me, and I will agree that this is not 2008 all over again, but the speed of communication that we've seen. Earlier, I was remembering 1920s and Morgan buying his stock on the floor of the exchange, Northern Rock bank runs. This happens faster, and regulators, as they did this week, have to be sharper.
That's exactly right. And again, you need to sort of draw a little bit of a line between the obvious things that Silicon Valley Bank got wrong. The fact that you can lose a lot of money on a long dated bond in a rising interest rate environment, and the things that are sort of unique here, which is I was on a call with regulators, and one of the regulators made the point that this bank operated in a uniquely incestuous, was their word, environment, meaning that the depositors and the investors and many of the people with relationships in this bank were in various chat rooms together, sharing their concerns. And this is to your point about the speed of communication. It's worth, of course, us doing some work to figure out whether other banks could be subject to that kind of community challenges, but it was unique in this case, I think.
I am troubled, Congressman, by the moral hazard question. I know it's sort of a hard-hearted aspect of it, but deposit insurance was designed to make ordinary people whole. When you have small businesses who say, well, if you don't pay us all out, we'll have to put people out of business, out of jobs, we can't make payroll, then they've got a valid point, but where do you draw the line? For example, does deposit insurance need to rise to a more realistic amount, 500, 750,000?
Well, that's a really good question. And so we saw irresponsibility on the part of the risk managers inside the bank. I suspect we're going to find, just as you alluded to, irresponsibility on the part of some of the supervisors of the bank. But let's face it, those people who put $50 million into deposits in one bank, knowing full well it's on a sticker on the door of the bank that account is only insured to 250, they also bear some blame. And this is where the moral hazard comes in. So we know two things. We can't guarantee every last dollar in the banking system. That creates an immense amount of moral hazard with respect to how the banks would then use those dollars. So I think inevitably we're going to see treasurers, and we are seeing treasurers move deposits into other short-term places for their cash. The problem with that, of course, is that that's going to put tremendous pressure on our smaller and medium-sized banks. And we're going to need to grapple in the medium term with what we need to do to make sure that we don't become a country of a couple of mega banks.
Okay, so it's Friday night. We're all going off after a very long, exhausting week, as I'm sure you are, and you'll have plenty of work over the weekend. Can you reassure us tonight it's not 2008 again?
Oh, absolutely, Richard. This is nothing like 2008. In 2008, the money center banks, the city banks, I remember when Citibank almost went belly up, were overloaded with profoundly toxic paper. That is not true today. The fundamental structure of the banking system is very sound. What we had was a panic where people said, I need to withdraw my money now. That's a classic bank run. They've been happening for hundreds of years. Really where we are today bears almost no resemblance to the really toxic environment of 2008, 2009.
Really, all left for me to do is wish you a good weekend, Congressman, and thank you, as always. Thank you for joining us.
Thank
you.
Thank
Now,